Hey, it's Steve Pemberton with Pemberton Homes and eXp Realty. I thought I'd shoot a quick video today and just discuss some of the things that are of topic and people are talking about. One is the federal funds rate and what does that mean with your home mortgage. The other piece of this is going to be, what do I do if I'm under contract and interest rates go up? Or what if they go down? So I'll address both of those. Currently, the federal funds rate, as most of us have been keeping pace of, at least those of us that are in the financial world or the real estate business, we had interest rates in the last several years of near what we call zero. And that's what people were referring to is that rate, the federal funds discount rate. That's the money that the federal government loans money to lenders, banks, at their most preferred rate. The bank then in turn turns things around and they loan money to corporations and also to consumers in the form of auto loans and other loans. And they'll usually base their interest rates on short-term borrowing on what's called the prime interest rate. The housing market typically deals with the 10-year treasury bond. So that's the number that we look at when we look at interest rates rising and falling. A lot of what happens too is the fact that when interest rates are changing, the market is already what's called priced into that equation where they think the rate is going to go from the Fed. So what do we do if we're under contract and we're excited, we've found a new home and we've made a good buy and suddenly interest rates go up? Well, if you haven't locked your mortgage, you are at risk of having to pay a higher rate. So one of the things that we always encourage people to do at Pemberton Homes is always plan for the worst. And in the event that something really great happens that's to our benefit, then we benefit as a result of that. But for example, if interest rates are at 6.5% or at 7%, and those numbers I know for many of you sound like they're very big numbers, but I've done this for more than 4 decades and I actually sold homes when interest rates were at 17.5%. So they have a long way to go, and I don't think it'll ever happen in my lifetime again where that'll occur. But back to the topic, if in fact you're working with a lender, you want to check with the lender and find out if they have what's called a float down option. So if you lock in your interest rate at, let's say, 6.5% or at 6.75% for a 30-year loan, and interest rates actually fall during the time that you are in a pending sale transaction, find out if that lender that you're working with will do a float down option, which allows you to then have the lower rate. So that's one. Two is it's a risky environment to float the interest rate, but many of you that are building homes, you don't have much choice. You really have to take a position where you're out there 6 months, 8 months, 9 months, and you're at the mercy of the market. So there are builder programs that will also lock in interest rates, especially on spec homes. So again, what this all comes down to are really two things, and it's being said quite a bit lately. One is love the house, date the rate. So you're borrowing money on a short term, and as interest rates fall, you can always refinance. What we saw happen in the 1980s and 1990s and in the 21st century is that as interest rates fell, people then refinanced. And typically you can refinance at little cost as long as you know that within the first 2 years you can cover your closing costs. That'll be a whole nother topic. But I hope that's been helpful for you. And I would say again, those two important pieces of that axiom, which is love the house, date the rate. Thanks very much for watching. Steve Pemberton, eXp Realty, Pemberton Homes. You can always reach me at 612-386-8570 or steve@teampemberton.com. Thanks so much.